a 50 basis point move is a desperate move, in my opinion. It's what you get in a recession-style scenario, and that's not what we're looking at least not imminently. So, yeah, I think the markets are pricing around a 35% chance of that 50 basis point cut, but I think we would need a growth scare from something like the payrolls for the August report to really kick that off.
So looking into the data from yesterday, what we saw in the numbers, the CPI wasn't as cruel as the PPI, so it was enough to suggest we're going to get potentially some rate cutting from the Fed, just not 50 basis points. What did you make of some of the stubbornness still in the data when it comes to, say, the housing segment, which has been all dominant?
Yeah, that's very important as well, because the inflation was mainly driven by the lag components, right? So there's shelter, which makes up 34% of the index overall. Leading indicators have pointed to some more progress down the line. I think everyone's expecting that to come down over time. And also you've got auto insurance, which mainly represents a recuperation of losses that they've caused over the past few years. It's more of a catch-up than anything else. So we know that's going to come down as well. And those two marked the majority of the rise, right? So there's very little inflationary pressure throughout anywhere else in the economy. The uptick in rent was important, but I think you can put that down to volatility. I wouldn't be too concerned unless that turns into a trend.
The last meeting, Fed Chair Jerome Powell spoke about how the risks are balanced on both inflation as well as the jobs market or the overall growth market here as well. Do you think that really is the case, or is it a case now of less inflationary risk being at play now and the focus really being keenly on growth, especially that labour market?
Yeah, I think that's exactly right. I think that you can't say job done, but I think we're all but done. We're pretty much there on inflation. It's no longer an obstacle to rate cuts. I think the pace going forward is going to depend on that growth data. And I think the CPI, in particular, single data point, is going to be focused on less compared to where the labour market's going, where growth is going, how quickly they need to sort of introduce these rate cuts to pull the economy up.
Yeah, Carl, have you been surprised at all, or perhaps concerned by Fed commentary or communication, as it were, particularly in this rate hiking cycle to right now having this higher for longer stance? Because it feels as though it hasn't been coordinated, or it hasn't been structured in many ways, because you'll get varying views at almost every data point. And I point again to Raphael Bostic, as I said a little bit earlier. Just Tuesday, he had been saying that he wants more data before he can support a cut. Then PPI comes out, and then CPI comes out, and then it's all of a sudden enough to warrant, yes, maybe more confident now to cut. Is that worrying that you're not actually sure where the Fed sometimes sits, or is it a case of, well, they're data dependent?
Yeah, absolutely. I think that's a big sort of source of uncertainty in markets at the moment. That is driving volatility from every single data point. I think there is a sort of, or there should be a trend, as you see in the ECB and the Bank of England, where they are more moving towards that forward-looking view, where they're really putting their confidence in the outlook of 12 months' time, 2 years' time, rather than reacting so heavily to every single piece of data. So I agree that it's too much. There's no need for every single piece to completely upend your outlook, and I think that does create unwarranted volatility.